Hi guys, it's Stock Curry, and the stock market just finished its worst quarter since 2020. On top of that, the yield curve just inverted. So in today's video, we're going to look at the economic and earnings data to figure out where the stock market is going to go from here. So let's get into it! The stock market just had its worst quarter since Q1 of 2020, which was the start of the pandemic, marked by a 20% drop in the stock market. For the first quarter of 2022, the Dow finished down 4.6%, the S&P finished down 4.9%, and the Nasdaq finished down 9%. There was also a lot of news, some good, some bad, that came out on the last day of the quarter on Thursday, so let's talk about it. President Biden announced he is releasing 1 million barrels of oil per day, but that's really not going to make that big of an impact. The United States uses 20 million barrels of oil per day, so the extra 1 million barrels might help drop prices by about 5%, but that's all. Brent crude oil prices dropped 4.88% on the news, and U.S. crude oil prices dropped 6.99%. That's in line with the impact the extra 1 million barrels of oil will have. The Personal Consumption Expenditures Price Index, or PCE, came out on Thursday. This is the Fed's preferred measure of inflation, and it measures how much consumers are spending on goods and services. The index was lower than what analysts had expected, which might be pointing to a slowdown in the rate inflation is rising. Further, real disposable income, that is, the increase in disposable income minus the increase in inflation, was down 0.2%. That points to inflation rising faster than income growth or wage growth, which means the amount of income consumers can spend is decreasing. As consumers have less to spend, that will decrease demand, which should eventually decrease prices and inflation. On Friday, we get the March jobs report, and everybody will be looking at the wage growth to see if we are starting to see a wage growth spiral or not. A wage growth spiral occurs when wage growth exceeds inflation. That points to inflation getting out of control. And if inflation gets out of control, the Fed will be forced to raise interest rates even faster than they are initially planning on doing. Also on Thursday, the yield curve officially inverted intraday again, although it still closed in the positive at 0.04 or unchanged from Wednesday. When the yield curve inverts, it means a recession will start sometime between 12 and 18 months, typically, from the date the yield curve first inverts. So it looks like a recession will start sometime between April and October of next year in most cases, although a recession could start as early as 7 months or take as long as 24 months. Now, because there have been cases where a recession started sooner than 12 months, some people think we might already be in a recession. Keep in mind that we won't know for sure if we're in a recession or not until we get 2 quarters in a row of negative GDP growth. So we have to be in a recession for 6 months before we actually know we're in a recession. So let's take a look at some company earnings to see if there are any signs that the economy is slowing down, or at the very least, that inflation is hurting profits. Goldman Sachs missed earnings in January due to surging expenses, mainly wage growth. As inflation continues to rise, that will put downward pressure on earnings unless companies can pass those earnings on to consumers. When companies no longer have pricing power, that is, when they are no longer able to pass the rising cost of inflation on to consumers, then their earnings will go down, and that can be a signal that the economy is slowing down and might enter a recession. Now, we're already seeing that with banking stocks such as Goldman Sachs, but we have not yet seen it with goods stocks. So far, consumer goods companies such as Procter & Gamble have been able to raise their prices, so their earnings have not yet dropped. Their earnings have actually increased as inflation has gone up. But JP Morgan and others are getting concerned that inflation will eventually hurt them and that these companies will lose their pricing power. That's why analysts are starting to downgrade consumer goods companies such as Procter & Gamble. On the housing side of the economy, we're already seeing mortgage applications drop significantly as rates rise. This will lower the number of people buying houses and also lower the price they can pay for a house. Eventually, that is going to cause a drop in housing prices and leave many homeowners upside down, just like we saw in 2008. That is already causing investors to sell off housing stocks such as Toll Brothers as they anticipate lower earnings from housing companies. Toll Brothers stock price has continued to decline even as the overall market rose significantly in the past 2 weeks. So overall, we are definitely seeing signs of the economy slowing down, although earnings have continued to risen on the earnings reports that we've gotten so far, even if those earnings reports have been a little bit below analyst expectations. And a lot of the signals that we're getting for a recession so far have been forward-looking, meaning analysts are downgrading companies' stock prices and stock prices themselves have been going down. Although earnings have actually continued to rise, especially last quarter. So while we are getting some signs of the economy slowing down, we are not getting any signs of a recession yet. So it looks like a recession will still not start until next year at the earliest. So with the yield curve inverting, and especially with it being a 100% accurate predictor of a recession, is now the time to sell your stocks before things get worse? Well, it's important to understand that while the yield curve is a reliable economic indicator, it is a poor market timing tool. In fact, if we look at this chart here, you can see how during multiple times the yield curve inverted, the stock market actually hit a new all-time high prior to a recession starting. Now, that being true, I think it's important to look at the period during the 1970s and 1980s the most, because it was the only other time in history when the yield curve inverted due to the Fed raising interest rates because of high inflation. And specifically, I want to focus on the period during 1973 because that was when inflation was starting to rise just like it is now, and we also had oil shortages and very high oil prices just like we do today. So during those 4 periods in 1973, 1978, 1980, and 1988, the stock market hit a new all-time high prior to the start of a recession in only one of those time periods. In the other 3 periods, the stock market hit a new all-time high after the recession started. And if you remember from my prior videos, I talked about how the market will rise after a recession starts because the Fed will start lowering interest rates in order to bring us out of a recession, and the stock market will react favorably to that. But I also want to highlight the 1973 yield curve inversion, which was actually the time period that was closest to where we are today economically with both rising inflation and sky-high oil prices. In 1973, the market hit a new all-time high 2 months prior to the yield curve inverting. The market last hit a new all-time high about 3 months ago, so it's possible that we will not get back to a new all-time high prior to this recession starting next year. While it's only happened one time before that the stock market did not hit a new all-time high after the yield curve inverted, it's also true that that one time was during the most similar economic period to where we are today. Still, the stock market hit a new all-time high after the yield curve inverted and before a recession started 63% of the time. I should also note, though, that the median amount of time it took for the stock market to hit a new all-time high was 18 months, which means we might not get to a new all-time high until October of next year. What that means for you is that it's still a good idea to dollar cost average into your long-term hold plays. Although, if you want to hold cash until we officially enter a recession, that's not a bad idea either. That's actually what I'm doing. I'm just going to keep holding cash until we officially enter a recession, and then I'm going to load up on my long-term hold stocks. That's because when we do officially enter a recession, that is almost always the bottom in the market, because it's at that point that the Fed starts to lower interest rates again and the stock market starts to rise on that news. Now in other news today, Gamestop rose over 17% after hours after announcing a stock split. GME rose to $204 after hours before giving back some of that gain. The stock split will still need to be approved by voters, so there's no timeline on when the stock split will occur. The GameStop news also sent AMC higher in the after hours. Earlier in the day, I sold my AMC put spread for a 37% overnight profit. I plan to use the proceeds to buy more shares of AMC. I'm also still holding the QQQ put spread I bought on Tuesday, and I'm currently up 94% on that. If you want to know everything I'm buying and selling so that you can make 94% profits also, I post all of my trades in my VIP Discord. And I post the trades before the trades are filled so that you can join in on these plays also. You can get my trade alerts by joining the VIP Discord at stockcurry.vip/getvip. Again, if you want to make 94% profits with us, you can join the VIP Discord at stockcurry.vip/getvip. Alright, I hope you enjoyed that video and get a lot out of it. Comment down below when you think the stock market is going to get back to new all-time highs. And if you want a broker that's super easy to trade the multi-leg options on, the ones that we've been making a ton of money with over the past few weeks, then I do recommend Webull. Webull is by far the easiest broker to trade multi-leg options on. That's why I use Webull for my trading accounts. If you want to sign up for Webull and get 2 free stocks worth up to $2,300, you can use my link in the description below to sign up. You just have to deposit $1 after signing up to get your 2 free stocks. Now also, I wanted to let you know that if you're not a US resident and you still want to trade these multi-leg options, you can do so with Interactive Brokers. I also have a link for Interactive Brokers in the description of this video as well. Now finally, I want to remind you to hit that like button, subscribe, and click the bell icon and click all so that you can get notified when I release my next video. I hope you have a lot of success trading, and I will see you on Monday.